Today will be remembered as a turning point, not because XRP suddenly launched into the stratosphere, but because a quiet structural shift finally became visible to the public. For years, the debate surrounding XRP centered on utility, liquidity, and regulatory friction. But this morning, when the first US-listed XRP ETFs officially went live, the conversation reorganized itself. XRP stepped out of the shadow of speculation and into a regulated investment framework designed for scale. Price movement, the signal. Within the noise across the market, traders woke up to see XRP holding above the $2 level. But what truly mattered wasn't the number, it was the behavior. Instead of a chaotic price spike, XRP delivered a controlled, steady climb into the 220s. Institutional products were opening, yet the market didn't behave like a speculative frenzy. It behaved like a system beginning to stabilize around new demand. The opening hour of ETF trading reflected this perfectly. Roughly $14 million of combined ETF volume hit the books. Not explosive, but undeniably strong. Bitwise, Franklin Templeton, Grayscale, and Canary all brought their products online. And the early flows made one point clear. The door is finally open for retirement funds, advisors, wealth managers, and compliance-bound capital that previously could not touch crypto rails. What you saw in the XRP chart today was the market pricing in access, not mania. The most experienced traders know that institutional inflows rarely appear as dramatic surges. They show up as consistent pressure over weeks. Ethereum proved it. Bitcoin proved it. Now it is XRP's turn to demonstrate what regulated exposure does to a token built for settlement speed and global liquidity. Why today matters far more than the price. Candle an ETF is not a trend. An ETF is an infrastructure upgrade. It is a pipeline that will run every day the markets are open. It allows for accumulation, rebalancing, automated inflows, and long-term positioning from entities that function on multi-year cycles, rather than intraday speculation. For XRP specifically, this development hits differently than it did for Bitcoin and Ethereum. XRP was created for utility, not scarcity. Demand is supposed to come from usage, not just investment. So now imagine what happens when utility-driven demand and investment-driven demand begin, operating at the same time, inside a regulatory environment that finally recognizes XRP as a legitimate asset. Today was not the climax. Today was the calibration, the institutional lens. What big money saw today, large capital allocators do not buy headlines. They buy liquidity, regulatory clarity, and smooth price action. XRP delivered all three today. It held strength above critical support. It reacted positively but rationally to the ETF launch. It showed no signs of structural weakness. To a portfolio manager, that is a green light. Not to buy today, but to begin watching for sustained order flow. The fact that XRP didn't explode upward is exactly why institutions are comfortable entering slowly. They prefer predictable markets, not chaotic spikes. Make no mistake, this moment marks the beginning of a long arc. You will see step-based rises, retracements, consolidations, and new baselines forming. ETFs do not produce overnight euphoria. They create long-term upward gravity, the kind that lifts quietly until one day you look back and realize the entire chart has transformed. The bigger picture, XRP's role in the new financial rails. The timing is not accidental. While global liquidity remains strained and many digital assets are searching for narratives, XRP's ETF emergence arrives precisely when tokenization, real-time settlement, and cross-border interoperability are becoming necessities, not experiments. This is where XRP has always held its strongest position. Today's ETF does not merely give investors exposure. It signals alignment. It suggests that traditional finance is willing to adopt XRP into systems where compliance and predictability are non-negotiable. That shift is the real story. Not the 220 candle, but the structural recognition of XRP's role in the transition to digital settlement rails. What comes next? Expect 3 phases. 1. Observation phase. Now. Analysts, funds, and advisors will monitor early liquidity and price behavior. 2. Accumulation phase. Weeks to months. Wealth managers allocate slowly, scaling in via scheduled entries and rebalancing strategies. 3. Utility convergence, 2026 plus. As tokenized assets, on-chain settlement, and institutional rails expand, XRP begins benefiting from both utility and investment demand simultaneously. This is not hype. This is architecture. This is the beginning of the next chapter. And as always at LTL Productions, we cover the story before the world understands what it means.